Well, hello, everyone, and thank you for joining us today. This is a very popular, timely topic, so we do have a big group with us. We're going to give people a few minutes to settle in and get connected. And while we do that, I'm Leanne, I'm your host. I'm just going to give you a bit more information about today's broadcast. So first things first, we do have everyone on mute for this session, but we still hope to hear from you and get some of that interaction that we would all have if we were face-to-face. So I want to draw your attention to the Q&A chat box towards the bottom of your screen. Since we're expecting a lot of questions about today's content, we have a panel of experts from our advanced financial planning team who will be writing back to questions as Andrew presents today. So depending on the nature of the question you ask, we will either try to respond directly to the person asking, or if we think it's relevant, we'll actually share both question and response with the entire group so everyone can follow along. At the end, we're going to have our experts cover off a few of the questions. We've also included a resource list that you can refer to during our webinar today, and we'll send the same resources out to you in the follow-up email. If you click on that, you'll see that you can download the PDF and also an infographic that summarizes all of the government relief programs and relevant links. So I'm going to go ahead and present our speaker for today. You can see him waving at you live in the video screen. If by any chance you don't see him or you don't hear him, it could be that you're having an internet connection issue, so please just refresh that and it should bring back your live feed. Andrew Mackenzie has a 27-year career in the financial services industry. He's currently responsible for supporting high-performing consultants and helping Canadians achieve financial confidence. He's a trusted authority on topics including retirement and estate planning, investments, and protection strategies. He usually presents to rooms of people face-to-face, but he's getting used to doing these virtual seminars, as we all are. And even though he doesn't have to, we wanted to let you know that he is wearing pants today. So with that, I'm going to hand it over to Andrew.
Thanks very much, Leanne. Let me just get to my slides here. Okay. First, before I get started, what I wanted to say to everyone is I hope you're healthy and safe at home. I know this has been trying times, and many of the programs that are coming out right now are quite confusing. That's why we're doing this session today, to try and shed some light on this for you and help hopefully add some clarity to the decisions that you're going to have to make going forward. So here we go. What are we going to talk about today? We're going to cover the 5 principles of your financial plan, because I think that even though we're here to talk about COVID measures, we never want to take our eye off that ball. We're going to talk about tax date extensions that have been implemented by the government. We're going to talk about economic support measures for individuals and for businesses and employees. And we're going to talk about our approach to creating your living plan. So why don't we get started? The 5 principles of your financial plan. I'm going to go through these in detail. But what they are is use time to your advantage, and I'll talk to that. Diversify your portfolio and why you should. Avoiding emotional decisions, which can be a very difficult thing to do at a time like this. We want to maintain a long-term focus and, more important than ever, stay invested. So let's take a look at that. This slide looks like a bunch of circles. Really what it is, it's a measure of volatility. So if you can take a look at the first circle on the left, it says 1 month returns. And you may not be able to see it very clearly depending on the size of your screen, but in 1 month periods of time, you have a 39% chance that your portfolio is down and a 61% chance that it's up. Those are the stats. So what happens if we extend that out to 1 year? That goes to 27% chance that you're down and a 73% chance that you're up. Now I'm just going to pause there for a moment, and you're starting to see the picture, and I'll conclude it for you in a moment. But what this is really playing to is the difference between risk and variability. At times like this, especially when our portfolio statements from January are going to be down, on our more recent ones in March, we want to keep in mind that risk and variability can be 2 very different things. Over a short period of time, like 1 month, you can have a great deal of risk, even over a year. But as we move into a 3-year time span, your risk of having a negative portfolio return drops to 10%. Over a 5-year period of time, it's 2%. Over a 10-year period of time, it virtually never happens. So the moral of that story is time reduces risk and turns it merely into volatility. And this is going to be a theme that I'm going to go through a few times in this session, but it's sort of like playing with a yo-yo while you're walking up a hill. As you can imagine, the yo-yo is going to go up and down a lot more than you're going to make steps going up that hill. But over time, you get to the top of the hill, even though the yo-yo has been going up and down the whole time. So use time to your advantage. This slide plays into why we should diversify our portfolio. And that is, if you take a look at the box on the screen right now, you'll see a whole bunch of asset classes. It could be Canadian large cap, US, international, European, emerging markets, fixed income, and the like. And what the box shows on the top are the top performers and the bottom performers and all the way down. And as you can see by the box, there's not a lot of sense that you can make out of it. It could be different one year to the next. And certainly the top performer one year could be the worst performer the next. So we never really know which one's going to outperform the other. And what that means is we need to stay diversified. I love this slide, although I prefer it with facial emojis. And what it talks to is the emotional side of what goes on right now. As you can imagine, when markets start to go up from a period where they were down, like in, say, 2008, 2009, and when they start to go up again, we become encouraged. And then we become confident. Maybe we start to dip our toe into the water. After that, we get excited. And we've got some money in there, and it goes up further, and we become jubilant. And we're as happy as we can get. And then the markets start to go dip back down again, as they inevitably always will over time. We get a little agitated, and we get distressed. Maybe we make some moves. Then we go to despair, maybe even nauseous, and then we become dejected. And that is the point of maximum opportunity, typically. Then we become encouraged again when the markets start to go back up and the cycle repeats. In other words, the biggest thing we need to do through all of this is manage our emotions and remember to stay invested and stay diversified. This is a picture of the number of positive years we have had in the markets versus negative years. The negative years are in the light blue, the positive years are in the dark blue. And the further you go out on the scale, the more severe the negative or the more severe the positive. So what this slide clearly demonstrates is 70% of the time the markets go up. And I think what's even more encouraging and more demonstrative of a time like this is if you take a look at the outer edges, there's a lot more dark blue than there is light blue. In other words, the rebounds tend to be extremely good, and we don't want to miss them. And I'll talk to you a little bit about that right now. And what this slide, I love this slide. What it talks to is on the very left, the two bars, the blue, dark blue, and the light blue bar. What they are talking to is being fully invested for the last 30 years. In the dark blue bar, it's a mix of Canadian and U.S. equities. In the light blue bar, it's just U.S. equities. And if you take a look, in the U.S. equities, you would have made 7.7% return. If you had missed just the 10 best days out of 30 years, your portfolio return would drop by 2.4% on average, just missing the 10 best days. If you look at the best, or the 50 best days, if you miss those, your portfolio returns become negative. In other words, we need to stay invested, or we're going to miss the big rebounds that will add profit to your portfolio. Now let's get into the meat of today's topics. We're going to talk about tax date extensions. They're fairly simple. So for individuals, self-employed, corporations, and trusts, the tax payment date has been extended to September 1st. Now, normally these four categories have different dates, but the one thing you want to keep in mind is September 1st is when you have to have your taxes paid by if you owe income tax, and they haven't given relief from that. So you want to make sure and keep that date firmly in mind. If you're a business owner, GST, HST, import duties, and taxes have been extended to June 30th, and it might be noted that CRA audit activity has been suspended during this time of crisis. Although there's a bit of a caveat to that, and I'll bring that up a little bit later, because the CRA auditors may be otherwise employed at the moment, but they're going to be employed again, and we want to keep that in mind. So let's take a look at some of the support measures for individuals. And what I want to do is I want to give you sort of a ringing bell. And at the beginning of the titles for all of these programs that the government has put out, Canada Emergency, if those are the first two words, it's a fairly extreme measure. And this is one of those. So this is the Canada Emergency Response Benefit, or CERB for short. Also dealing with the EI program that is in place. They're very much interlinked. The CERB program is offering a taxable benefit, so it's not tax-free, of up to $2,000 per month for up to 16 weeks. And it's going to apply to people who had to stop working due to COVID, or you're eligible for employment insurance, regular sickness benefits, or have adjusted their EI regular benefits between December 29th, 2019 and October 3rd, 2020. Now, what's going to happen is if you're on EI prior to March 15th, you're still on the EI program, even if it's less than $2,000 a month. So that doesn't change. As of March 15th, if you apply for EI, you're actually going to apply for the Canada Emergency Response Benefit, and that's the easiest way to apply for that is to go onto the My CRA website. CRA, like everything else in the world these days, everything's going online, but the CRA has long had the My CRA program in place, so you can go on and get signed up for that. One little word for you, before you go and get signed up for that, you may want to have your tax return from the previous year handy, because one of the tests to sign up for it is you're going to have to put in one of the lines from your tax return from the previous year. Now, how do you qualify for this? Well, you had to have income of greater than $5,000 in 2019 or the previous 12 months. You also must be over age 15 in order to qualify. So what I'm sure there's going to be a lot of questions on this. We got a lot the other day. So what I would encourage you to do, ask your questions. We will get them all answered for you, and I will carry on to the next program. Now, this talks to support for parents of low-income families and seniors. Now, there's some things that you need to take action on, and there's some things that you do not, and I will identify those for you. Just for your knowledge sake, if you get the Canada Child Benefit, you're going to get a $300 increase on that payment in May, and you don't have to do anything to get that. The Goods and Services Tax Credit, again, if you qualify for that, as a single person, you're going to get an increase of $400. And if you're a couple, you're going to get an increase of nearly $600. And that's going to occur in May. And again, there's no need to apply for that. It's automatically applied. One thing that you will want to know about, because it is optional and you have to take action to get it, is there has been a reduction in the required RIF minimum payment for 2020 due to the COVID crisis. So that means that if you had to take out $10,000 from your RIF in 2020, this year you only have to take out $7,500. Now that's going to be a very personal decision, whether you need the money or you don't. If you don't need the money, you may want to apply for this. The only thing you have to do is go to your financial institution and request that that be done. If you deal with us, all you have to do is talk to your consultant, and we will look after the rest for you. Now, mortgage support and student loans. Mortgage support is being offered in the form of 6-month payment deferral. One thing that I want to note about this is, while you may not have to make a payment over that 6-month time frame, which, by the way, you do have to request, the interest that you're paying on your mortgage will continue to accrue. So it's not that you're being forgiven on your interest, it's just you don't have to make your payment. That's one question that we frequently get. If you're dealing with us, what we are going to do is work with you to find a program that will most suit your needs. And again, all you have to do is talk to your consultant, and we will look after the rest. As for students, student loans, recent graduates are going to be given a 6-month interest-free moratorium on the repayment of Canada student loans, meaning that they won't have to make any payment for the next 6 months. And again, for this one, there's no need to apply. Support for parents, low-income families, and seniors. I just went through that one. And let's get to the summer jobs program. The summer jobs program, many of you are probably not aware if you're not an employer, but if you are an employer, you may be aware. If you're not, you may want to take advantage of this, even under normal circumstances. But what the Canada Summer Jobs Program does is it offers employers a subsidy of up to 50% in normal years of the minimum wage as an incentive to hire students for summer jobs. So obviously they cover half the wage, so that's good. The COVID change, or the measure that's being taken now as an incentive for employers to continue to hire summer students, is they have offered to cover up to 100% of the minimum wage in the province, in this case Ontario obviously, and the program is being extended to February 28, 2021. So or an employee, you may want to be well aware of this. Even if you're an employee, let your employer know, because with these programs in place, it can help your employer remain viable through this time frame, meaning you're going to have a job to go back to, and that benefits all of us. Let's take a look at some measures supporting businesses. So again, Canada Emergency Wage Subsidy, this is a fairly severe response. So it's very generous, although you do have to qualify. And what it's going to do is cover up to 75% of wages to a weekly maximum of $847 per week per employee. This will also cover CPP and EI contributions. So if you can imagine, what this does is it covers all of the payroll costs plus 75% of wages. So the only thing the employer is expected to do is to cover 25% of the pre-COVID wages that they were paying to their employee. As you can imagine, this can be quite a chunk of change. Now, when does this apply? It's retroactive to March 15th, so you can go back and apply for it from that period of time. And it's a 12-week period from March 15th to June 6th, and split into 3 eligibility periods. How do you qualify? Well, this is the tricky one. In March, you must be able to demonstrate that you had a 15% reduction in income from the previous year, or you can compare it to January and February of this year. Now, that's for March. For April and May, you have to have had a 30% reduction. And so if you don't have those, obviously you wouldn't qualify for this program. And it's not based on the number of people that are employed. So it's pretty broad-based, and it can be very, very generous. Now, it applies to all normal compensation models, salary, wages, other remuneration that would normally be paid, but it does not cover severance items, stock options, that sort of thing, so the extra benefits. It's really just an emergency measure. So that's the Canada Emergency Wage Subsidy. Now, if you don't qualify for that one because your reduction in income this year hasn't been so great, the one thing that we do all know is that COVID has impacted everybody. And so even if you're still getting by fairly well, you've probably been impacted to some degree. And so this program is designed to help those people out. And what it does is it's going to be equal to 10% of the remuneration paid up to a maximum of $1,375 per employee, or $25,000 per employee. So that's what it is. Now, the way that you are going to access this, they're not going to give you money. What you're going to do is to continue business as usual, but where you would normally remit taxes on behalf of your employees to the government, what you're going to do is simply stop remitting to the amount that you're eligible for this program for. So that's how you're going to go about doing it. If you've missed the boat on this one entirely, you'll be able to go back and claim it later, and you can apply that to taxes for this year or taxes for next year. It should be noted that any benefits provided under this program are taxable. Now, the one thing you do need to have is the 15-digit payroll number so that you can remit when you remit your taxes to the government. So you do need to have that in order to qualify for this program. Now, taking a look at Let's get there. We've got a couple of repeat slides here. And extending the work sharing program. Now, here's something that a lot of people are unaware of. Employers may be aware of it. I'll tell you what it is. It's for those employers that are cyclical in nature. And maybe, say, for example, they have 10 employees and they value all 10 employees. But there are periods of time where they really only need 5 employees. So what they are able to do is do a work sharing program, where part of the compensation would be EI benefits and part of the compensation would be the wages that they earn at their employment. And so that's what this is all about. And so what has gone on with this program is they've extended the eligibility from 38 to 76 weeks, and they've eased eligibility requirements and streamlined the application process. So for this one, you're going to get all of the links where you can go on and do your research. If this one applies to you, we will give you all the tools that you're going to need to deal with this. So let's move on. Now, this is really just a warning to employers out there. These are challenging times, but labor laws still apply. So before you're going to lay off an employee or entirely let go of an employee from your employee, you need to make sure that you're operating within existing labor laws. And so my greatest advice to you at this stage of the game is, if you are contemplating letting some of your employees go, what you may want to do is contact a lawyer and just make sure that you are going to be within the guidelines that the government asks employers to abide by. Now, increasing credit. So the first one, business credit availability program, is really just $65 billion that the government has laid out to help companies through tough times. And so what you're going to want to do there is simply talk to your financial institution about taking advantage of this. There's also support available for farmers. So it's really just money that's been earmarked by the government to help out during this time of crisis. The last one, or the one on the right that you're looking at, the Canada Emergency Business Account, which again, Canada Emergency says it's a fairly drastic measure, and this is one that gets a lot of press. And what it will allow you to do is to qualify for a loan of up to $40,000 to get you through the tough time. It is interest-free for the first year. And the big kicker is that 25% of the loan that you take out is going to be forgiven as long as it has been repaid by December 31st, 2022. So my comment to this one really is, in a moment, there's going to be some people that are going to be able to go out and get a $40,000 loan and stick it in their bank account for a number of years until they have to repay the $30,000 that they have to repay and pocket the rest. I'm going to suggest to you that if you do this, you're probably opening the door to audit. And the challenge with that is, when they audit, they'll audit everything. So you may want to be careful about this one and make sure that if you're going to take advantage of it, that you really need the money. Now, I've covered off all the programs. As you can see on the screen, there are a number of links to all of the various programs that I've talked about. One thing that I did forget to mention is and I'm just going to scroll back here to my slides for a quick second if I can. And I'm going to get to the Canada Emergency Response Benefit. The one thing that I did forget to mention is, and this is a caveat, I don't want to forget to do this. The rules are changing very quickly, and there's one change on here. Actually, there's been a few changes that I've presented to you here tonight that only changed over the last 2 weeks. The rules changed from April 1st, April 15th. So the one thing that I would encourage you to do is keep your eye on the changes that are occurring. And the one thing that I did want to let you know here is, previous to this, you had to be making no earned income in order to qualify for the Canada Emergency Response Benefit. On April 15th, they announced that you can still earn wages up to $1,000, but not in excess, through normal employment, and still qualify for the Canada Emergency Response Benefit. So keep that in mind, and keep in mind that you're going to have a number of changes that are going to occur over this time. So please keep your eyes on what's coming up next. So I'm just going to move on here to our approach to creating a living plan. Now, having gone through all of the changes to COVID, the one thing that I do want to sort of step back from the whole thing and take a look at is it has been certainly a disruption to everyone's life as it stands today. And so what tends to happen at a time like this is we do what I call, we look at the trees instead of the forest. And the forest is your overall financial picture, your ability to retire, your ability to educate the kids, your ability to save income tax, your ability to buy the cottage or rental property or whatever else you want to do with your life, all of the goals that you've laid out for yourself. And the only reason we have money is to satisfy goals, let's face it. So we want to make sure at a time like this and take stock. So managing your cash flow efficiently and effectively is more important now than ever before. Preparing for the unexpected. If something happened to you, would your family be okay? Now is a very real time to take a look at that. Planning for major expenses, maximizing your business success, optimizing your retirement, all things that you should take a look at right now. And these are what we do. Now, I want to take a moment and explain our process. But before I do that, I want to tell you that we are fully set up to do business. The response that IG Wealth Management has had to this crisis for the consultants in the field has been nothing short of extraordinary. We have DocuSign ability, we've got online video capability, we've got absolutely everything we need to have in order to continue to service you and do your financial plans. The only thing we can't do right now is see your face live and shake your hand. We'll get back to that all in good time, I'm sure. But we are perfectly set up to help you right now. And here's how we do that. The first thing we're going to do is to take a look at your current situation. And I mean in every detail. And what that does is it gives us a starting point. Everyone has goals and they want to achieve them over time. So we've got our starting point and our desired ending point, right? The plan is paving a road between the two. How do we get from here to there? And so what we're going to do at the first meeting is understand what is your situation in its entirety today. Then we're going to talk to you about what your goals for the future are. And then we're going to sit down, aside from you, we're going to come up with a financial plan, pave that road, as it were, and create your financial plan for you. After we've done that, we're going to show it to you because you're going to want to see it. There may be some adjustments that need to be made, and we're going to come up with something that is really suitable to you and that you're comfortable with. From there, of course, we implement and we get it rolling. Now, the other thing, and I will caution you to this, is proactively monitoring and adjusting your situation is more important than ever before. COVID-19 has displayed that rather well. Like the Apollo mission going to the moon, most people are unaware that it was off track about 99% of the time. But what would happen is they'd fire a little jet, bring it back on course, and fire a little jet, bring it back on course, and the rocket made it around the moon and home safely. And so that's what we need to do with our financial plans as well, because life and finances are anything but static. Now, we also don't do this alone. As you can imagine, no one person can know everything. So just like tonight, we've got one of our advanced financial planning team on staff to answer your questions. And these are estate planning lawyers, tax lawyers, accountants, and other professionals that are there in the employ of IG Wealth Management. And they're here really exclusively to make sure that we give you the very best answer to the most complicated questions that you'll ever ask us. And we're very good at that. In addition to those, we have region and division teams. We've got insurance specialists, security specialists, mortgage specialists, all on staff to answer any question and come up with that ideal financial plan for you. Now, once we've done all that, we can also stress test your plan. Because one of the questions we get a lot is, well, I did a financial plan. I thought I knew where I was going. My portfolio is being impacted by this market downturn. What's it done to my plan? And so one of the things that we normally do in our financial planning software is we do what's called Monte Carlo analysis. And what Monte Carlo does is it's going to randomize your rates of return. It takes into account times like this. And what it's going to do is come back to us, as you can see on the screen, with a percentage likelihood of your plan coming to fruition. So not only can we tell you to the dollar what you can retire on, how much your taxes are going to be at death, what your insurance needs are, on and on. We can tell you every answer to every question you're ever going to ask us to a dollar figure. We can even give you a percentage chance likelihood that it's going to happen, even in an unforeseen world. So we're going to be able to give you a great deal of clarity. Now, the one thing that I would say is at a time like this, you may be scared and you may be nervous and you may have your eyes on other things. But I would say that at a time like this, it's more important than ever before to take stock of where you're at, because it's a funny thing. I call it the 2 o'clockies. It's where you wake up at 2 o'clock in the morning worried about something and you can't get back to sleep for a few hours because your mind's spinning. One of the biggest culprits of that problem is financial worries. And so if we are able to show you what your financial situation looks like and create a path for you, you're going to have clarity. And if you have clarity, you don't have to worry so much anymore. So with that being said, I just want to summarize by saying, please have a plan. Get that in place. It'll make you feel far more comfortable. Diversify. So stay invested. Discipline and focus will serve you well over time. And this is a great opportunity to take stock of where you are and make sure that you're still headed in the right direction. So we're going to switch over to the live Q&A again, and I'm going to go off the screen, but I'll be here to answer your questions along with the panel. So thank you for joining us here today, and please stay safe, and we'll see you on the other side of this thing. Thanks, everyone. Our advanced planning team on staff to answer your questions, and these are estate planning lawyers, tax.
Well, hello, everyone, and we are going to go into some of our questions right now with our panel. And this was a very active Q&A session. We know that there are a lot of questions out there. We have Blair Evans with us today, who's from our advanced tax and estate planning team, as well as a few more of our regional directors joining Andrew to help us get back to as many of you as we possibly can. So I'm going to start with a few questions for Blair, because a lot of people wanted to know just more specifics on the government programs. And I'll start with a question that we had from Maria and also a few other people. How do you know if you should apply for EI or CERB?
Thanks, Leanne. Great question. The decision's really been simplified. When the program was initially announced, there wasn't a lot of clarity, but it's been simplified. So if you've lost your job on or after March 15th, you'll automatically be processed under the CERB program. One thing to clarify is how you would actually apply. So whether you apply through the EI program or CERB, you're going to be processed through the CERB program. But there's two different application processes, and they both lead you to the CERB program, but it's important to realize which one you should apply under. So individuals that were employed either full-time or part-time for at least 8 months last year, so in 2019, they'll be processed through Service Canada, and other individuals are going to be directed to the CRA's online portal.
Great, thanks, Blair. And just a follow-up question for that, I think you started to hit on it, but we had some people saying, what if for some reason they've actually received payment from both programs? Are they going to have to pay back one of the two reimbursements that they've received?
Yeah, that's a great question. I've seen it come through a couple times today. The government specifically notes on their website under their frequently asked questions that you can't receive benefits under both. So you're either receiving your EI benefits or your Canadian Emergency Response benefits. So if you do receive both, you do have to pay one of them back. And the government has provided good clarity on their website in terms of how you would pay that back if you receive a benefit in error. If you received a check from the government and you haven't cashed that check, you would automatically just send the check back. If you have cashed your check already, or if you've received a direct deposit, what you would do is you would just send them a check along with a letter, and the letter would indicate that this is a repayment of your, for example, your Canadian Emergency Response Benefit. You would make the check out to Receiver General and then put CERB repayment in the memo line.
Great, thanks Claire for clarifying that. Another question, and we received a lot of questions about the student programs. There were some announcements this week from the government about how they're going to be handling that. We understand that there is still more information coming. So we'll give Blair to give us an overview of what we know right now and what we still don't know, because it sounds like on today's call, a lot of our clients have, the parents of teenagers. They want to make sure that their teenagers are taking full advantage of the government programs available as well.
Yeah, thanks, Leanne. That's a question that's come in a lot, and it's been a real hot topic over the last couple of days. On Wednesday, the government announced support of nearly $9 billion for post-secondary students and for recent graduates. One of the measures they announced was the Canada Emergency Student Benefit. And the Canada Emergency Student Benefit right now mentions it provides eligible students with $1,250 a month, and that benefit's increased to $1,750 a month if the student has dependents or is disabled. And that benefit is going to be available for May, June, July, and August, so for 4 months.
Sounds good. And we did have a question about the impact on OSAP as well. Do you want to cover that?
Yeah, I think we've had a couple questions with regards to details on student benefits. And one thing I want to mention is the information hasn't been posted to the finance website yet. So I think that's a great question. And hopefully that's something that we'll get clarity over in the coming days or by next week.
Great, thank you. And someone was asking, now, if someone hasn't worked yet, they don't necessarily have a CRA account, how would the government go about being able to get that reimbursement to a student?
Yeah, no, great question. And they haven't clarified it on their website, but I would imagine it would just be paid through a check being sent to them. They haven't clarified that yet. That's something that I would expect in the next couple of days. But if they don't have a CRA account, people are encouraged to use the account if they do have it. But if they don't have it, I would imagine it would come just via check.
Sounds good. I'm going to switch gears, and I have a question for David, and it's one that he actually answered through the Q&A, but it's such an important topic that we want to make sure we cover it with you here today. There's been significant disasters like the Great Depression in the past. People are wondering, will COVID actually put us in that type of a market situation, and how should we think about that in terms of market recovery?
Thanks, Leanne. I know a lot of people are really concerned about the state of the markets and the volatility that we've been experiencing. And as Andrew reviewed in the content of the presentation, there have been a number of periods over the years and the last number of decades where we've seen significant sell-offs, as an example being the financial crisis of 2008 and 2009. And after each subsequent market event and significant sell-off, we do tend to see a recovery happen. And the number of time periods where we've seen positive market action compared to negative market action, there's more positives than negatives. And what we do see historically is that when the market recovers, it does recover rather rapidly. And the risk that people face is, removing themselves from the recovery opportunity. And that's why it's really important that you have that conversation about your asset allocation mix and about the suitability of your portfolio with your advisor. I hope that helps.
Very helpful, thank you. And Bill, I have one for you that I think it would make sense to talk about with the bigger group. It's one that you were helping Allison out with on the Q&A. In addition to the government programs, there's also some mortgage relief programs. And people are wondering, what are the pros and cons of deferring mortgage payments in terms of how that fits into their overall living plan?
Yeah, I think that one starts eliminating any sort of misconceptions that are out there, because there was a lot of confusion and some people were under the impression that the deferred mortgage payments weren't going to be charged interest. And all of the financial institutions are allowing, as part of the program, clients to defer. But those deferred payments, the interest is continuing to compound on them. So obviously, if someone needs the cash flow, then that's why the program was developed in the first place. But if people can afford to continue to make their mortgage payments, they're going to be far better off in the long run doing so.
Great. Thanks for that advice, Bill. We had another question, and I think I'll throw this one over to Blair. A lot of sole proprietors joined us for today's call, and you know, at IG we work with a lot of business owners, and we are constantly helping them navigate some of their questions. It seems to be a common question for the sole proprietors that are hearing about the programs that are available from the government. But if they don't have employees, you know, is there any benefits that they can take advantage of?
Yeah, great question. That does come up fairly often with respect to questions on the Canada Emergency Response Benefit. One of the great benefits about the Canada Emergency Response Benefit, or the CERB as it's often called, is it's got broader applicability than you see with a lot of the other measures. So the CERB is available for employees, for contract workers, and for self-employed individuals. So self-employed individuals should really look at the criteria to see if they would meet that. Again, on the CRA's website, they talk about the criteria being that you have to have stopped working. Again, the individual has to be at least 15 years old, and then they have to have a certain amount of income in 2019, and I think they've mentioned $5,000 from certain sources. So if they do meet those conditions, then they would be eligible for that CERB.
Okay, great. Thank you. And I have a question that just came in that I'll throw to Andrew, assuming that he's had a chance to have a drink after giving that presentation. We heard from Anka here, and she's thinking about retirement. And she's saying, you know, if we're in our retirement and we're kind of facing this market volatility, how do we know if we have enough time to stay invested? So, Andrew, I know you tried to cover that off a bit when you talked about Monte Carlo and the living plan, but why don't we give you a chance to answer that question and give a little bit more detail?
Yeah, sure. That's an excellent question. The only honest answer I have for you is you have to do your numbers. And so if you can imagine, my analogy to that one is for most people in their financial life, it's like standing at the top of a mountaintop, but shrouded in fog. There's a beautiful view, but you can't see it. And so at a time like this, especially when markets have pulled back and you're wondering whether I'm still good or not, the honest answer is most of the time, if you were good before, you're probably still good now. But the only way to know is to run your numbers, and that's with doing a comprehensive financial plan. And the software that we have available to us can run your numbers based on today's market values, and we can still tell you to the dollar how much you're capable of retiring on. Because some adjustments may need to be made. You may have to reduce your income to some degree, but probably not to a greater material degree if you were on track prior to this. But the easy answer is the only way to know is to run your numbers. And so I'd encourage you as highly as I can to get that done.
Sounds good. Thanks, Andrew. I'm going to ask a question to Bill again, and it's related, but someone just wrote in and they said, how can we get a hold of, you know, our Monte Carlo goal coverage for retirement? Is there a self-navigated tool available online? So I know that we have the living plan tool, but Bill, I'd be interested to hear the advice that you'd give to Catherine if she's kind of looking to make this happen for herself.
I'll be honest, I've never seen a Monte Carlo type of analysis that's just kind of floating around on the web. I've only ever seen it in really sophisticated financial planning software that financial planners such as ourselves use. So the best advice I can give is reach out to an advisor and have them build the plan and have them run the Monte Carlo.
Sounds good. Yeah, I think with something as important as this, it's really best to get that customized advice and get all of your numbers and put into the simulator and really take a look at things for yourself. So we did actually include, if anybody wants to request a virtual meeting for any follow-up. I know some of the questions we're getting here are quite specific to people's situations, so we're really happy to have you fill out your information there. And you know, Blair, I thought one thing that might be helpful for you to cover for us would be when someone does go to their advisor and then they are navigating some questions relating to tax, can you kind of explain how your team fits in helping with that overall plan?
Yeah, I can definitely give some more context on that. So if a client has a question and relates to tax or estate planning, they would reach out to their IG consultant, and their IG consultant would look at the question, and if it's something that requires more in-depth tax or estate planning advice, they would reach out to our team, and a member of our team, either a tax accountant or a tax lawyer, would look at the question, would provide advice, and would chat with the IG consultant. And if the client would like, they would reach out to the consultant. The consultant could explain any information that was given on that.
Great. And I have one more question to throw to David. Someone's asking us again, you know, but I don't understand what is the Monte Carlo. So I'm going to give David just one quick chance to describe that again for people, because we're getting a lot of questions on that in the live chat.
Certainly. The Monte Carlo analysis really takes, let me back up a bit. When we go through the financial planning process and we take all of a client's financial data and what their financial goals and objectives are, the advisor consolidates all that information and inputs it into our software. And really what the Monte Carlo analysis does is it takes all the assumptions that we have put in, and then it, for simple purposes, it lives your life multiple times. And if we take a look at what we're dealing with right now within the markets and the volatility we're experiencing, the Monte Carlo analysis will create different scenarios where we've had years of, say, you're living your life with all the assumptions where there's excellent returns and then very poor returns. And what it does is it shows the probability of you achieving a financial goal rather than answer the question, what is the average rate of return, or what is my average of achieving my goals? Because averages assume that you have an equal number of people achieving a goal as well as not achieving a goal. So that's dangerous. Probability gives you far more certainty and confidence as you move forward towards whatever your financial objective is, whatever that goal you're planning for is. So the Monte Carlo analysis really runs multiple lifetimes, taking all the assumptions that we build into your financial plan to create that scenario probability.
Great, thanks so much, David. It looks like we have a few more questions that are pretty specific for Blair, so he will try to write back to those on the chat if they include specific details and information that don't make sense for us to talk about live. But we did want to just draw your attention to the resource list, because that is where we've included an infographic that gives up-to-date information about all of the available government relief programs, as well as a PDF of today's slides. And we are taping this live broadcast, so you'll also get a playback if that's helpful for you as well. I did have a question. I think we'll let Blair address it, and then we'll probably pass over to David to close us out for today. But we have a lot of retirees on our call today, and they are kind of worried about where things are at with their portfolios. So that's why I think we kind of need a few different perspectives on this. Blair, are we hearing anything from the government about any potential support for retirees coming from government programs?
Yeah, one item that I think definitely bears discussion for today is the reduction of the RIF minimums, and then again, that's a measure that's applicable directly to seniors. So generally, individuals that have RIFs are required to take out a minimum amount from these accounts every year, and that withdrawal is included in their income. The minimum amount has been reduced by 25%.
Runs multiple lifetimes, taking all the assumptions that we build into your financial plan to create that scenario probability.
Great. Thanks so much, David. It looks like we have a few more questions that are pretty specific for Blair. So he will try to write back to those on the chat if they include specific details and information that don't make sense for us to talk about live. But we did want to just draw your attention to the resource list because that is where we've included an infographic that gives up-to-date information about all of the available government relief programs, as well as the PDF of today's slides. And we are taping this live broadcast, so you'll also get a playback if that's helpful for you as well. I did have a question. I think we'll let Blair address it, and then we'll probably pass over to David to close us out for today. But we have a lot of retirees on our call today, and they are kind of worried about where things are at with their portfolios. So that's why I think we kind of need a few different perspectives on this. Blair, are we hearing anything from the government about any potential support for retirees coming from government programs?
Yeah, one item that I think definitely bears discussion for today is the reduction of the RIF minimums, and again, that's a measure that's applicable directly to seniors. So generally, individuals that have RIFs are required to take out a minimum amount from these accounts every year, and that withdrawal has to be included in their income. The minimum amount has been reduced by 25% for 2020. So meaning that if your original RIF minimum was, for example, $8,000 before the change, it's now been reduced to 25% to $6,000. So again, this is going to be helpful for some seniors who may not need that income for their living expenses. And if they don't need that income for their living expenses, then that 25% can continue to remain in their RIF account and benefit from tax deferral.
Great. Thanks for letting us know about that, Blair. So at this point, I will hand over to David just to kind of close us out for today, but also try to give people some confidence about what they can do if they're not feeling so certain about where their portfolio is at and what they can do and take some next steps as we continue to learn more about this topic.
Thank you, Leanne, and I'd like to thank Andrew for delivering the content today and for the support of Blair and Bill in the Q&A. You know, just so many people are going through a large period of uncertainty right now. We all are, and whether you're a business owner, an employee, a student, retired, everybody's got a lot of questions and there's a lot of uncertainty. And I think, you know, the purpose of today is to hopefully answer some short-term questions and address some of that uncertainty. But when we are in periods of uncertainty, we often feel that we don't have a lot of control. And one of the suggestions and the key takeaways from today is putting a little bit of control in your hands and giving yourself some more certainty and going through that process of evaluating your financial preparedness and evaluating the impacts of the current market conditions on your overall financial plan. And that really starts with having a meaningful conversation with your advisor to really test and stress test your financial preparedness and your financial plan. You know, whether it be having the Monte Carlo analysis run for you and to show you that you're on track from a probability perspective, or just answering the questions that you want answered on a more personal basis. That's what we're here for, and that's what we excel at. So with that, I would like to thank you for your attention, encourage you to speak to your advisor, to engage them in a meaningful conversation about your financial plan, and above all else, take care of yourselves and your families, and please stay safe.